Hello and welcome to another episode of Bidishanomics. I am Sabika Syed and with us Dr. Bidisha Bhattacharya, our consulting editor for economics, who takes your questions, dear members, on economy, India's position, how global affairs are impacting us. Bidisha, the first question is by Lakshmi Narayan. They're congratulating you on the Pakistan episode, thanking you for an insightful piece. Uh, they were reading that the whole of India gets 14 million tourists, while New York City alone gets 60 million tourists in a year. Of course, New York is the business capital of the world, so may not be apples comparison. Still, we do have a beautiful country. Is there a way to establish the opportunity, cost of lost tourism, and link it to government not investing in public infrastructure and making our cities clean? We can't expect people to come visit Delhi with the air quality we have.
Absolutely. Firstly, thank you for watching the Pakistan episode. Now, coming to your question, it is definitely a question that needs to be addressed, and it also is kind of a fun trap because if we look at the numbers to be specific, here we are comparing a country with a city. So we often confuse the definition or we often confuse the numbers. We get it wrong because the entire definition of tourist depends on which number you choose to look at, right? So specifically when we talk about India in 2024, approximately 9.95 million uh, tourists or specifically if we call them FTAs, not free trade agreements, but foreign tourist arrivals, which specifically means people who have crossed that border, foreigners who have come to India as tourists to be specific. Then comes also ITAs, which are international tourist arrivals, which is where the NRIs come into the picture. People who are studying, domestic, Indians who are studying abroad, who are living abroad for different reasons. They are traveling, meeting their families and their friends and everything. So that comes under the international tourist arrivals as well, which increases the number from 9.95 to approximately 22.5. There are reports of it being 27.5. Now coming to New York City, as you have also said specifically there are reports that it has welcomed 65 million tourists
Right.
and international tourists. Now if we look a little deeper into the numbers, approximately 12 to 12.5 million out of that 65 million has actually been foreigners who have visited the New York City, and the other number, the rest of the number, is actually people, domestic American citizens or American tourists from the NYC tri-state area, which involves, let's say, Philadelphia, Washington DC, or LA, Boston, people who've come to meet their friends,
Right.
family, cousins. So that is majorly domestic American tourism. So if we look at the numbers now, 12.5, 9.95, or even 22.5 for that matter, then of course India attracting tourists is of a kind of a level playing field or at par with that number. However, here comes a very, very important point, and which is why I said that with all with all the necessary geographical sort of benefits and geography that we have been endowed with, it doesn't make any sense for us to compare with a city in America. And by geography, I mean not just we have 14 UNESCO World Heritage Sites, we have the Taj Mahal, we have Himalayas, we have three coastlines, deserts. Despite all of that, what is exactly that is, holding back?
Right.
Sort of tourist arrivals or tourist travels, and it has actually dropped. Lakshmi Narayan, he's absolutely right that the number has dropped. And what is the exact reason? So here, before I address the reason specifically, I would like to talk about one economic concept that we had addressed even in earlier episodes, but this applies heavily in this answer, which is the concept of opportunity cost. So basically, what you are letting go by not choosing the smarter available option. So here is where pollution plays an important role, or clean air, public goods, basic sanitation, footpaths, proper footpaths, clean water for that matter. So here, let's say for instance, if a foreign tourist is preferring Bangkok over Bihar, or if a company is preferring Singapore over Mumbai, for a conference. Just because the air there is more breathable, please understand that this does not then remain confined to being an environmental issue anymore.
Right.
Because then you are losing money, you're losing revenue, you're losing profit, and you're failing on trade now. You're failing on investment, because right now, a foreign tourist coming into India and spending dollars, purchasing, different commodities in India, is very similar to India exporting commodities to the rest of the world. Because ultimately, at the end of the day, foreign exchange is entering into the economy. And there have been multiple reports that show of the loss in revenue that India has suffered because of air pollution, because of not proper access, or because the air in general is not breathable. This brings us to the other part of the question that basically asks that, okay, so what is the air quality bill or the direct tourism link? How do we link tourism with air pollution? Has there been studies so far? There have been multiple studies so far that actually measures or quantifies the loss. The first study is by a World Bank based study that found out that pollution or air pollution leads to a 0.7% annual decline in tourist arrivals, which could lead to a loss in revenue of $1.7 billion. Now, in any country for that matter, and specifically in India, that's a direct quantifiable link between, unclean air and the economy or the GDP of the economy in general. Then if you look at the bigger picture, that's even scarier.
Okay.
There is a Lancet Countdown 2025 report, and I would like to read the estimates here. It has estimated 1.72 million deaths in 2022 because of PM 2.5, which is the fine particulate matter, fine particles which are smaller than even 2.5 micrometers that penetrate deep into your bloodstream, your lungs, and that is causing also a loss because of premature deaths, lower productivity, because of labor suffering health conditions. So there is an economic cost of that of approximately $340 billion, which translates into 9.5% of GDP. Then coming into to a very, very interesting report in January 2026, which directly hits at Indian businesses, which was by Dalberg and the Clean Air Fund, that had said that in 2024 alone, fine particulate pollution alone accounted for a cost by Indian businesses that they had to incur of $260 billion in loss of revenue, which amounts to approximately 6% of GDP.
Okay.
So the problem, this is not anymore, in my opinion, a Delhi ki sardi problem anymore. It is making India rank as one of the, India has ranked as sixth most polluted countries in the world, with 66 out of 100 cities, most polluted cities, being in India, and New Delhi obviously being the first in the rank. And then now there is a very important point that economist Geeta Gopinath made in Davos this year, and that kind of invited a lot of praise as well as criticism. But the numbers back the claim that she made. She said that air pollution would cost Indian economy way more than tariffs will, and the numbers are backing her up. I'll just give you an example, or just basic numbers in general, that India, the merchandise exports from India to the US is 2%, roughly 2% of India's GDP. Now, if there are tariffs that are imposed of 10 to 20%, then that amounts to annually a reduction up to, let's say, 0.2 to 0.4% of GDP. Now, compare that to just the numbers that I've mentioned right now. The pollution is costing Indian economy 10 times more. Then, so if I now connect the dots, it is not that India is not being able to sort of improve or enhance in tourism because it does not have a better ad campaign, for that matter. It is because of the public goods that are not available, clean water, sanitation, roads, proper roads. And you're absolutely right, we have these heritage sites, we have such brilliant diverse geography, but we're not being able to tap into that economy, which could actually stabilize our economy, stabilize our foreign exchange reserves, even from an investment investment point of view, just because of this opportunity cost that we are choosing to ignore, and we are not choosing to quantify it as a cost, as a loss, and somehow it will opportunity cost in general is something that if you ignore it, it just relocates and it grows even further in the future, and it'll reach a point where definitely it will start discouraging serious long term investments.
Yeah. Now, Bidisha, Narendra Arya's question is how big India is in the aviation component industry and how close India is in manufacturing engines for aircraft. Apart from GTRE, which major global aero engine manufacturing companies are expanding in India, is India inching towards full-fledged manufacturing of defense and civil aircrafts?
Now, this is, of course, a very interesting question. And because this is probably the first time in Bidishanomics, this question is pushing us to talk about high-tech manufacturing.
Right.
So far, we've spoken about micro, small, and medium enterprises. We've spoken about other, facets of manufacturing, but high-tech manufacturing, which is aircraft, aerospace parts, manufacturing is something that we have not spoken about. And you have asked very serious, sharp four questions, and I'll address them one by one. The first is, how big is India in aircraft parts? Now, this is the easiest to answer in my opinion, because India is doing well in this particular area. So India's aerospace parts manufacturing market is projected or valued at, let's say, $13.6 billion in 2023, and is projected to grow 6.8% every year. So approximately it has to be, or it is projected that, or evaluated to grow up till, let's say, a $22 billion market in by 2030 for sure. Specifically, a company like, let's say, Airbus has alone, it plans to procure $2 billion worth of components and services from India. Right now it procures $1.4 billion by 2030. So now, let me just clarify here that when I talk about, aerospace parts manufacturing, it does not mean that India is manufacturing complete planes. I'm talking about cabin interiors, different parts and components that India is sort of focusing on and manufacturing and growing in this particular area. And they delivered the same or send the same to companies like Boeing or Airbus. And of course, the main hub for this, or aerospace hub, is Bengaluru, followed by Hyderabad and Pune as well, who are focusing on this area. Then comes the second part of the question. So obviously, we have established that especially in this parts manufacturing, aerospace parts manufacturing, India is a growing global player at this point. Coming to the second part of the question is that, can India make its own jet engine? Now, from a fighter jet angle, I don't think so, but there have been some very serious progress that has been done in India. To be specific, India has been trying to develop an indigenous engine called Kaveri since 1989, which was supposed to be powering the Tejas fighter jets that we have, and it was being worked on and developed by this gas turbine research establishment under the DRDO, GTRE, under the, which has also been mentioned in the question, under the Defense Research and Development Organization. Now, the Kaveri was meant to power the Tejas fighter jets. However, because of certain regulatory standards, or it was failing in the engine thrust area, to be specific, it was de-linked from the Tejas program in 2008. So now the Tejas fighter jets specifically run on the American GE engine, which is F404. Now coming to specifically, is there any news? Recently, we have a news that is quite exciting. There is a dry non-afterburning version called the Kaveri Derivative Engine, or KDE, that is supposed to be powering the India's Ghatak stealth drone. Now we are talking about the India's Ghatak stealth drone, which is under the Unmanned Aerial Combat Vehicle, UCAV. So specifically that in February 2026 as well, there was the engine completed a successful sort of full afterburner test before the defense minister himself. So now it is up for certification by June 2026. Now, after this dry version would be certified, GTRE plans to work on something called the Kaveri 2.0, which would be powering the Tejas 2.0, or the stronger fighter jets that we plan to come up with, which would be targeting, let's say, 80 to 90 kilonewtons of engine thrust. Of course, I mean, think of it this way, that Kaveri is kind of graduating, it will start from drone and then over the time sort of develop into engines that could power these fighter jets, but not anytime soon. Moving on to this very important part of the question, which talks about who else is investing here besides GTRE. Now, there is something very promising coming up, when you look at the reports lately in this particular area, that the main global engine makers are actually betting on India at this point. Specifically, first talking about the GE Aerospace, which is the American engine market. That has agreed to co-produce in principle. I mean, the technical discussions are done, but when it comes to pricing, those negotiations are still going on, but we can expect that to be done by the end of 2026. So GE Aerospace, this American engine giant, has decided to co-produce F414 engine with India, with the Hindustan Aeronautics Limited, HAL, and nearly 80% of the manufacturing capacity and also intellectual property rights completely would be transferred. Now, at this depth, investment US is doing for the first time with India. So which is quite promising, and definitely there are, of course, also, the plan covers 99 engines initially to power the upcoming Tejas Mk2 fighter jet as well. Now, as I said, the complete agreement is not fully signed, but there are technical discussions that show a lot of positive progress. Then coming to Safran, Safran, which is the French engine maker. They just made a major move in November 2025. They set up a LEAP engine, MRO, which is maintenance, repair and overhaul of the M88 in Hyderabad, to be specific. And this is the first time out of France there is an M88 engine MRO facility that France has set up, because M88 powers the Rafale fighter jet that we have. So also a decade old partnership that Safran has with HAL. They are coming up with this SAFHAL, which is SAFHAL, this program, which is a joint venture where they are designing a new helicopter engine called Aravali. Also, Rolls-Royce has also come very, very far in this particular agreement, and they have agreed to invest because they see India as the third home market after UK. And this is a very interesting point, because Rolls-Royce has also mentioned specifically to expand into skilling and expand the India's workforce by 10,000 people at least, which is very interesting from the macroeconomic point of view, from the employment or addressing our unemployment problem and the skilling problem as well. Now, coming to the last part of the question, which is, is India close to full aircraft manufacturing? Now, that is something that time will tell, but there is a very clear example of the C-295, which is a twin-engine military transport aircraft, which has been set up in Vadodara, Gujarat. Tata has set it up with Airbus, to be specific. In I think the final assembly line has been set up in Vadodara, Gujarat. And of course, 85% of the structural and final assembly work has been done in India, with 13,000 parts all manufactured in India. So this is quite promising. And of course, the final assembly line has also been, the maiden test flight has been completed on the 10th of June 2025 and on the 10th of June 2026. And they plan to hand it over to the Indian Air Force by the end of this year. So specifically, but when it comes to civil aviation, this is the hardest part. It's very challenging. China has suffered greatly for a decade, trying to navigate into this when it comes to civil aviation, passenger jets. So this is something that India is still trying to work on. They have not built anything of this kind. So that is something that time will tell.
Now, Bidisha, in our past few episodes of Bidishanomics, we've discussed reforms quite a bit.
Yeah.
Amritpal Singh is asking, what major reforms do you think are needed besides farm laws in India?
Um, very precise and a very detailed question, I think, because of course, even on the 21st of November, when the four labor codes had been announced, simplifying the labor laws. So even there, I had written a piece specifically, understanding the four labor
Right.
codes and simplifying it, since the British India time as well. So definitely, what would be the reforms? I would like to categorize into four reforms that are needed and something that the Indian government needs to look into right away.
Hmm.
The first, unambiguously, is going to be the labor reform, specifically, the four labor codes, and after the 29 old central labor laws,
Hmm.
the government, because this is something that has just happened,
Hmm.
and this is something that the government has been working towards in implementation, in making sure that every state completely starts following it. So these four labor codes, there were 29 specific labor laws, one focusing on factories, one focusing on industrial disputes, one focusing on minimum wages. But now you have those four labor codes, one on wages, one on the industrial relations code, one on health, working conditions, and the other is on safety standards, to be specific. So now, why does this matter? This matters because for decades, we in economics we used to call this the missing middle problem. India has a lot of tiny firms and a few giants,
Right.
and no medium sized industries. Why so? Because every time this tiny firm, any one tiny firm, would try to expand and become a medium sized business, they would have to face these overlapping multiple labor laws that would discourage them over time to kind of expand their business or follow certain acts. So this is where this medium-sized enterprises or medium-sized industries we could not establish. We could not create a strong medium-sized industry in India, which is something the government is trying to address with this four labor codes, to be specific. Then comes, of course, now before I go to the next reform. When it comes to these four labor codes, trade unions have definitely spoken against this. They have revolted against it because these kind of make probably layoffs easier, or the fact that a new requirement of 75% of workers have to agree for a legal strike to take place. So these are, of course, there are arguments and people, unions going against that. That is something that's going on, but this is kind of a strong move when you are planning what you have claimed in the budget of 2026-27. That is to strengthen infrastructure even further, manufacturing even further. For that, you need to have medium sized enterprises, medium sized businesses. Now, coming to the second reform that nobody really wants to touch, because in my opinion it's politically radioactive, which is land.
Okay.
Now, land reforms is something where sometimes there are joint ownerships of land. So whenever businesses try to occupy or build one particular factory on land, they often don't know who to reach out to, who exactly owns that land. Those records are very unclear, very confusing. So this is where the government directly needs to address right away, because this is kind of creating. There was a previous question which spoke about the telecom power in Pakistan, that someone forced out of their home in 15 days. So this is very similar to same coin flip side.
Okay.
Basically, not there is no proper protection for businesses, for people, and that kind of reduces trust on the government. So land reforms is something that needs to be addressed right away. Basically, faster enabling of faster building of infrastructure, easy approvals, understanding clear land records. Now we have such a strong digital infrastructure. Why not utilize that?
Yeah.
Then coming to the third reform, which is also something in bits and pieces we have addressed in earlier episodes, which is courts and contracts or judicial reforms. Now, this is where, at least from the contract approval point of view, something immediately needs to be done. If you are a government who is constantly talking about achieving Viksit Bharat by 2047, then of course you'll have to achieve strong FDI, strong FPI, strong FDI investment, long-term investments, and for that contract approvals have to be faster. Why I'm saying there are details. There is a National Judicial Data Grid, which is the government's own official website that tracks all the pending cases of across all courts in India. It's a very interesting website. It has a beautiful dashboard. You should definitely visit it. So that says there are 54 million pending cases across India's judiciary by the end of 2025, out of which 48 million of those cases sit at district and subordinate courts only. So here specifically, that figure is there. Now the problem is, why is this happening? Why are there so many pending cases? Now when you look at that, you see that India has roughly 15 judges per 10 lakh people. Now this is against the Law Commission of India's recommendation that there should be at least 50 judges per 10 lakh people. So this is definitely overdue. You need to increase the number of judges, but at the same time there has to be proper commercial courts, for faster approvals, separate courts for faster approval of business contracts, to be specific, because otherwise what happens is any business, any small business, or any business for that matter, coming from abroad, any investor who would like to, let's say, build a particular factory here, if they see that their first contract is undergoing, decades of approval, then definitely for the next contract they'll think twice, or they'll move to another country for that matter when it comes to investment. So this is something, commercial courts using technology for faster approvals as well. So definitely this is something, even faster arbitration for that matter, settling disputes as fast as possible. Then comes to the final one, and here I have clubbed two sectors. There's a reason for it, because I feel that these two sectors have shown tremendous improvement, but have also not yet addressed a very important gap. Each of them, that is power and banking. So first I'll talk about power. Now in power specifically, there has been genuine measurable progress. So India's power distribution companies, or DISCOMs as we call it, for the first time they have shown a positive profit that they have earned from, a negative number, to be specific, in the financial year of 2025. And also when it comes to the technical and commercial losses, or the AT&C losses that we talk about, that has also gone down from 15.97% to 15.04%, which is approximately very close to a 1% drop. Now basically AT&C losses are the ones that cater to, loss in profits, or loss in money from thefts, from billing issues, from outages, from, old wires, old wire issues. But however, I feel that the core issue in the power sector has not yet been addressed, which is the accumulated losses over time, which has actually, the accumulated losses of these distribution utilities has increased from 5.5 lakh crore to 6.47 lakh crore. Now the reason is why. If there has been positive profit that has been claimed, AT&C losses have gone down, then what is exactly happening? Now here is where politics comes into the picture, because every time, and this increase that I mentioned, from 5.5 to 6.47, this has happened between 2021 and 2025. Every time there is an election, states promise free power to people, and they don't reimburse immediately to these distribution companies. That leads to these accumulation losses. So this is somewhere politics has to come up, with a proper framework in place. Just to win votes, they promise free electricity, free power, and then they don't reimburse these distribution companies at the right time, which definitely creates a lot of issues, especially in these power distribution companies. Now coming to banking. Banking specifically, there has been tremendous improvement when it comes to the non-performing assets. To be specific, I have written a piece regarding this as well, that gross NPAs or NPAs are at an all-time low, but this could also be a dangerous phase. We will show link that somewhere. So definitely when it comes to gross NPAs or non-performing assets. Basically meaning the loans that the borrower has stopped repaying for that matter, that has fallen from a peak of 11.2% to 2.1%. 11.2% it was in 2017-18, 2.1% by September 2025. Net NPAs, which is the gross NPAs minus the amount that banks already earmark to, or keep aside to cater to these expected losses. Even if we subtract that, even those net NPAs are at an all-time low, in fact, a 20-year low of 0.5%. Now, return on equity is basically how much profit or how much measurable profit can a bank earn against the stakeholders' money. Now, that has also improved over time. But despite all of this, with, and of course that the insolvency bankruptcy code, IBC, a lot of other different sort of measures taken by the central bank, by the government, has led to this improvement. However, there is one area that is still under very high stress that needs to be catered to right away, which is priority sector lending. Which is lending to farmers, lending to agricultural sector, lending to small businesses. This is an area where RBI is still struggling.
Right.
Now, this definitely needs some reform right away, and this needs to be looked into, especially if you are looking at, because, even now, during these tensions in the Middle East, we have discussed so much about import dependency of not just oil, but also of fertilizers. And how it might impact the agricultural sector, how it might distort the NPK ratio, which is already distorted in the first place. What does subsidized urea do, to farmers, to the soil health in general? At this point in time, priority sector lending matters very much.
Okay.
So this is something that needs to be looked into right away.
Okay. The next question is by Ranjit Pal. He's asking, what is the breakup of RBI reserve in $1 billion and the amount of money which can go out of India with 2, 3 or 5 days, like FII, selling stocks or bonds, etc., though RBI does not follow full convertibility of the currency?
Very interesting question. It's a technical question, but definitely something that we have earlier addressed about what contains in the RBI's forex reserves, but I think this is something that needs to be revisited. So specifically, I'll come to the first part of the question: what's exactly in the RBI's reserves? So the RBI's reserves has predominantly 4 components. The first is the foreign currency assets, which is the largest component of the RBI reserves, the FCAs. Now that has approximately, it's mostly held in US dollars, but it also has euros. It also has other currencies. It also has the US Treasury bonds and other central bank deposits as well. And this is the most liquid part of the RBI forex reserves. Then comes gold. Gold is the second larger component of the forex reserve. So this is specifically now this completely depends on the trend. Sometimes gold prices, there can be huge inflow of gold, huge buying of gold, or at times it might fall as well. And this is not as liquid as the FCA. Maybe liquid to an extent for investments, but not as liquid as the foreign currency assets. And then comes the 2 other, which is definitely coming directly from the IMF, the International Monetary Fund. One is the special drawing rights, SDRs, by IMF, and then you have the reserve tranche position that India has with the IMF. In case of any unforeseen circumstances, they can sort of withdraw that reserve, and both of them combined, the amount that is held in the forex reserves is approximately 23 to 24 billion dollars.
Okay.
Now by late May 2026, the picture had quite shifted, from, because during February 2026, the reserves were approximately 728 to 729 billion dollars. But then, of course, as we know, and we have extensively discussed about this, the RBI had to defend the rupee. It had to defend the depreciation of the rupee. So it sold some of its foreign exchange reserves. And by selling foreign exchange reserves, we mean that FCA component that it sold, the foreign currency assets. And then it fell to $682 billion. But now it is back up again to $703 billion. It's improving again increasing. But of course, I mean, by when we will reach to the all-time high is something that we will see over time. Now, coming to the second part of the question, question that, why isn't it free for all? How much money can leave quickly? This is where we need to discuss about something called the capital account convertibility. We had spoken a little bit about it in the earlier episodes as well. Now, India does not allow full capital account convertibility, and rightly so, because we are an emerging market, we are a growing economy. So if the rupee is also fully convertible, just like, let's say, the US dollar or the euro, overnight there can be huge outflow of capital or money that can take place. So there are certain areas where the RBI, or the central bank, and the government specifically monitors and does not allow full capital account convertibility. And as a result of which, we have been protected. I would like to give an example here. For instance, Thailand and Indonesia, they had been heavily affected because they had full capital account convertibility in the 1996-97 Asian financial crisis. So this was the time when we were shielded. Also China, for that matter, something I'll speak about later. But specifically when it comes to personal remittances, when it comes to real estate, these are areas, to be specific, or certain debt categories even, where full capital account convertibility is not allowed. But what you are asking, or the part of the question that you're asking, where he has mentioned about FII, but mainly the area where money can just flow in and out, and I term it as hot money, which is the foreign portfolio investment. So this is where we have seen huge amount of outflow during the tensions in the Middle East, something that we were experiencing for the first time since, let's say, 1993, when FPIs were actually allowed into Indian equities and bonds, for that matter. So I would like to mention the data here, how much money went out because of the foreign portfolio investments. So in March 2026, foreign investors pulled approximately $12.3 billion out of Indian equities in a single month. Now, this was as I said, the largest monthly outflow on record. Last time it had happened was in October 2024. If we take the exchange rate of that back then, which was between 83 to 84 rupees to a dollar, that would roughly amount to, let's say, $11.2 billion roughly. But this has to be the highest. In March 2026. Now, if you have to translate that in 2/3/5 days that has been mentioned. So even if we take those 22 working days, trading days of the March 2026, and 12.3 billion went out, then roughly that that calculates to 400 to 700 million every day that went out. So if we have to estimate, then roughly we can expect billions to go out through foreign portfolio inflows. And because we just saw a live case study happening in front of us, there is a possibility that this can happen. Now, coming to specifically, the last part of your question, why hasn't India broken under this? Very interesting part of this question, because despite so much of foreign outflows, we witnessed something which was very interesting, called domestic institutional investment. A lot of investment happened in SIPs, into the mutual funds, exactly. From the domestic investors. So this is where the domestic institutional investors actually came to our rescue and kind of saved us, and did not create a 1991 kind of a situation. And also back then in 1991, here we are talking about the reserves falling to $682 billion, which is roughly translates to 11 to 12 months of imports. But back then in 1991, the reserves had fallen so low that we could barely even pay for 2 to 3 weeks of imports. So we were in a much better position at this point in time. But something definitely, a lot of advancements, a lot of work is being done. As last episode itself, we had discussed as how to for NRI deposits, FCNR rates have been increased by the RBI. So there are different other measures that the central bank is adopting, but definitely this was the primary reason.
Okay. Now, Bidisha, for our last question today, we're taking Surbhi's question. She's asking, China holds billions in US bonds and dominates critical global infrastructure. But if China truly wants to replace the US dollar as the global reserve currency and become the ultimate superpower, shouldn't they let the yuan float freely in the market, or can they achieve global dominance while keeping their currency locked down?
Great question. So here specifically, I would first like to address the part that how much exactly does China hold of the US dollars? Or the US debt, to be specific. As of March 2026, China held $652 billion worth of, US bonds, and it has been quietly there are reports that it has been quietly selling off these US bonds since 2013, when it was an all-time high of 1.3 trillion for that matter. Now, here there is one catch. There are news reports, there are analysis that China is also routing some of that money through countries like Belgium and Luxembourg, which have also huge amounts of US debt and US dollar deposits for that matter, or US holdings themselves. But that is something, if we have more data, we'll be able to establish for that matter. Next, coming to, why can't China let its currency float freely? Now, same problem. That is also an emerging economy, a growing economy, and now China has emerged as a global manufacturing hub for that matter.
Right.
China does not allow capital account convertibility, come what may.
Okay.
And they have said that they have their 15th 5-year plan, and over time, by 2030 or 2039 for that matter, they will slowly sort of, increase, let's say, the capital account convertibility. But full capital account convertibility is something that I don't expect China to do anytime soon. And here, I would like to state that very recently I have written a piece on a database that OECD came out with, which is the magic database, they have called it, which actually goes on to show, just like their currency, how China has been providing industrial subsidies, and 60% of China's manufacturing growth has been due to state support.
Okay.
So not because, it is as highly competitive. Every other economy, every other country is as competitive, probably, but it is not because of competition. It is also because of the huge industrial subsidies, especially the solar manufacturing plants and the solar manufacturing area, to be specific, or even solar parts manufacturing. Now, China's question, China's currency, which is the yuan, or also called the renminbi, to be specific, that is something that, has never really opened up to a great extent, and they have actually benefited from it as well. Any financial crisis over time, they have been able to shield themselves. The Southeast Asian financial crisis, even the previous Asian financial crisis, China has always been able to shield itself because it has never allowed the capital account convertibility. Now, there's specifically the same reason, being an emerging economy, think of it like a dam. If you have multiple sort of doors open of that dam, water will flow in, but water can flow out also as easily. So that is something that China does not want at this point in time. Now, coming to that part of your question where you say, is China's halfway approach actually working? Now, coming to the third part of your question, is China's halfway approach actually working? Now, I should have mentioned this at the start of the answer, that there are evidences that this halfway approach is partly working and partly absolutely not working. So, where it's working, I'll say, approximately now China's cross-border trade, 30% of China's cross-border trade happens in yuan, which is up from 10% that was happening in 2017-18, which is a very good improvement on their end. Now, where is it barely moving? I would like to state some data points. The yuan just made up approximately in 2023 of 4.3% of global payments, compared to dollars 47% of global payments. So the entire conversation of de-dollarization and, China emerging as the most dominant currency, these numbers will tell you where it stands and how far it stands from the US dollar, to be specific. Then coming to the dollar holding up to 58% of the global reserves, the yuan just sits at 2 to 3% approximately. Now, the amount of yuan that is floating outside China, let's say, is approximately $234 billion. The amount of dollars that is outside America is $15 trillion. So it is 60 times smaller. Even when it comes to their own payment system, system against the SWIFT system. They have a CIPS, payment gateway system, that is still not autonomous or completely free of the payment gateways. They are still using the Western system, the SWIFT system, in some way or the other. That needs a lot of development and a lot of improvement. And so specifically when it comes to these areas, this halfway approach of trying to not allow full capital account convertibility, to an extent in terms of cross border trade, that's helping. But when it comes to domination of currency, they are far far behind than the US dollar.
Right.
So it's definitely, as per the data that's out there, it's definitely not working, but time will tell.
Yeah. Bidisha, that brings us to the end of our episode today. The conversation was incisive as always. Thank you so much for watching us, for sending your questions our way and keeping us curious. We'll be back next week with another episode of Bidishanomics.